Time and joining us today. Let's cut across to the Network 18 Reforms Reloaded event, and Shireen Bhan is in conversation with the DIPAM secretary.
Well, ladies and gentlemen, when GST was first announced, let's remember the markets were anxious, businesses were cautious, and households were curious. There was hesitation, there was even resistance, and yet over time, this very reform has helped reshape India's tax system and given businesses the predictability that they had long sought. Confidence followed, not overnight, but steadily, and trust was built brick by brick. Today, ladies and gentlemen, GST 2.0 is more than just a restructuring of slabs. It is a signal that India is ready to simplify and trust its business and its citizens with a system that's designed to fuel consumption, broaden participation, and strengthen confidence. It is fitting that this very day coincides with the date when GST 2.0 officially comes into force, a reform that could well spark a fresh wave of business momentum and festive consumption ahead of Diwali. The timing could not be more critical. The World Trade Organization now projects that global trade could expand by less than 1% in 2025. That is the weakest pace since the pandemic years. At the same time, the European Union is moving ahead with its carbon border adjustment mechanism, a levy that will directly tax exporters from steel to cement, and across Asia, supply chains are being reordered in ways that will decide who rises and who is in fact left behind. India, meanwhile, has reasons for confidence and optimism. GDP expanded 7.8% in the first quarter of FY26, driven by revival in rural demand and steady private investment. Forex reserves have crossed $700 billion. That's a record buffer against global volatility. The IPO market has raised more than 50,000 crore rupees just in the first half of FY25, making India one of the busiest primary markets globally. And yet, equity indices, which have remained volatile and choppy, continue to be driven higher by domestic institutional inflows. Foreign investors have, of course, been skittish. And that is why this summit matters. Reforms Reloaded 2025 is about asking whether policy ambition can translate into lived economic impact. Will GST 2.0 ease the cost of doing business and fuel consumption? That's the number one question on everyone's mind. Will disinvestment and asset monetization finally shift gears after years of debate? Can India match its reform narrative with resilience on the ground and credibility abroad? That is the purpose of Reforms Reloaded 2025. GST may be the trigger, but the canvas stretches much wider, from disinvestment and asset monetization to frontier technology, defense indigenization, renewable energy, and India's evolving role in reshaping globalization. Over the course of today, we will be joined by policymakers, key decision makers, industry leaders, investors, and global voices who are not only shaping these reforms but are also holding them accountable to their promise. And before we begin, once again, we would like to take a moment to acknowledge those who've made this event possible today. We couldn't have done this without our presenting partner, IDFC FIRST Bank. Thank you very much, Mr. V. Vaidyanathan, for giving us your support and for being here, coming in from Mumbai to be here with us this morning. Our associate partners, ITC, PhonePe, Reliance Industries, and our exchange partner, the National Stock Exchange. Thank you to each one of you. Your support reflects a shared belief that reform is not a one-time event, but a continuous journey that must be told, debated, and delivered. We hope that you enjoy this day of conversation, dialogue, and deliberation. Please keep your feedback coming. Please keep your questions coming. Do tweet, do join and engage with us on social media. Again, once again, ladies and gentlemen, many, many thanks for joining us here this morning.
Thank you, Shireen, for setting the tone for today and requesting you to also please come back on stage. We want to start the day as we are in a time of global shifts, slowing trade abroad, and India stepping up in BRICS and the G20 as well. At home, GST 2.0 is reshaping the Indian economy. The real question, can we speed up reforms to boost investment, competitiveness, and global standing? At the heart of this lies divestment and asset monetization. Are we moving fast enough to take us into that debate? Please welcome Mr. Arunish Chawla, who's the Secretary of Department of Investment and Public Asset Management, with a huge round of applause, ladies and gentlemen. Shireen, please.
better way to kick off Reforms Reloaded with the market-facing department of the Government of India, the Secretary of DIPAM right here with us, Mr. Chawla. What a pleasure. Thank you so much for joining us here. Before I talk to you about disinvestment and the disinvestment roadmap, I want to understand from you the broad picture within North Block at this point in time with the rollout of the GST, with the income tax cuts that were given by the government. The clear effort and message seems to be, as we heard from the Prime Minister yesterday in his address to the nation, boost consumption, drive consumption. The budget-making exercise is going to start shortly, Mr. Chawla. How does all of this stack up on balance as you get into the budget-making process?
Thank you. Honourable Finance Minister will speak about it in more detail in the evening. I'll just make two supporting comments. One, our government is providing a balanced support to the economy. And balanced support includes support to private consumption, and which, as you very rightly said, includes both the income tax relief that was given in the budget and this great GST 2.0 reform, which is being rolled out and which was announced by the Honourable Prime Minister, both from the Red Fort and yesterday. Secondly, we have not forgotten investment. We've not forgotten about productive investment and the need to increase the productive capacity of the economy. As you know, the budget this year provided for more than double-digit growth in capex, which includes both budgetary and extra-budgetary resources. And as you know, if you can see the CGA data which came out the first quarter, that investment, public investment through the budgetary sources was on target. Equally important, what is called the extra budgetary resources, where we directly come in and where the public enterprises play a role. The data we have as of end of July, we achieved almost one-third, about 30 to 33% of the yearly target by July itself, which tells you that we have front-loaded reforms. We have kept them on track. And the industry and the commercial side of the government is working on the global value chains, how to revisit them, how to reorient them, so that we can insulate our economy from the global headwinds. I also have one suggestion. We should not get obsessed with individual numbers. India is a growing economy. We are in a phase of growth convergence. And it is how we perform relative to the rest of the world that is what matters.
So which number should we not get obsessed with, sir?
It's the headline number which we all tend to get obsessed about. And the right way of looking at it is, say, in spite of global headwinds, the world is going to grow, say, at 3% or even lower. If we can grow double that in real terms and maybe exceed that, and that is what the early data shows, we should be thrilled. That is my suggestion.
Well, suggestion and point taken, sir. Let me now address the issue of disinvestment and what the government is likely to do as far as the disinvestment roadmap is concerned. You know, I talked about the markets, and the Indian markets have, of course, faced their own degree of volatility on account of the fluctuation of FII inflows, but that's been offset by very strong domestic institutional interest and domestic institutional investment into the stock markets. There really has been, in a way, a democratization of the Indian capital markets that we've seen. How does your department, how does the government intend to leverage what we see happening in the market? What can we expect? More public sector companies doing OFSs? Are we likely to see more IPOs? What can we now realistically expect?
Good question, and I entirely agree with you on the observation. The first dose or the first dose of financial inclusion was Jan Dhan, was Aadhaar, was UPI, what is globally called the India Stack. The second big structural change that has come about in our economy is this great democratization of our capital markets. And as you know, the foreign institutional investors keep moving in and out. They have their own sentiments. Last year, they gave us a tough time. And this year as well, you know, in the last few months, there has been great nervousness because of the reasons that you well know. To great comfort and great relief, the domestic institutional investors have become part of our capital markets in a very organic way and in a very democratized way. And if I can just quote you numbers, just say last closing financial year, if the FIIs were maybe slightly negative in the net sense, the domestic institutional investors poured in 6 lakh crores of savings and into the capital markets. So we have moved away from that era where everyone just kept money in fixed deposits and provident funds. And mind you, almost 2/3 of our domestic institutional investments, the mutual funds and the, more high net worth individuals, almost 2/3 of it is just individual investors. And what they poured in as 6 lakh crores is almost twice as the 3-year moving average, which is again twice of the previous 3-year moving average. And this year, they say from January till August, again, as the FIIs in a net withdrew 1 lakh crores, the domestic institutional investors poured in 5 lakh crores. And that is why our capital markets are the best performing world over. We have overcome the headwinds, and you can see they're now stable and looking forward to what today you call reforms reloaded.
So what can we expect as far as your pipeline is concerned, sir, both in terms of IPOs, in terms of public sector enterprises, public sector banks needing to meet the minimum float norms that the regulator has in place? Give us a timeline of what is on the anvil.
You can expect from us honest gratitude to the small investor.
Can you put a number to that, sir? What does that mean exactly?
So essentially what that means is that we started with a few market stake sales at the beginning of the year. We held up a bit in the days of nervousness, but as markets have stabilized, we will bring in value creation opportunities for small investors. We will bring in more OFS, we'll bring in minority stake sales, we'll bring in maybe a few IPOs, and we will speed up this journey. And I will also congratulate and thank CNBC-TV18 because you have helped us connect the policy space, the market space, the investors together in such a beautiful manner.
Well, thank you very much for that, and we look forward to being able to continue to do that, sir. But, you know, so the second half of the year, IPOs, minority stake sales, and OFS, do you intend to make that disinvestment target of 47,000 crore rupees, or perhaps this time, for a change, beat the disinvestment target as well?
Fingers crossed, beat it this year.
Beat it this year. You're feeling confident about that?
Absolutely.
IPOs, sir, on the insurance side, are we likely to see IPOs from the insurance companies? Are we likely to see IPOs from the defense space? Because that's a space that the markets are at this point in time fairly excited about. Where could we see the next set of IPOs coming in from the public sector?
It would not be fair for me to name individual companies.
You can give us a sector.
Yes. But broadly speaking, what you said are the right sectors. And in these sectors, you will see various forms of minority stake sales through various methods, the SEBI-approved methods. And we, as you said, have a good target in mind and maybe exceed it so that all these small investors who have reposed their faith in us, we repay the gratitude back to them.
So how do you then respond, sir, to the comments that have come in from many market observers and market watchers who say that, look, the disinvestment story in India is dead?
I would refute that very strongly. we tend to pick up stereotypes very quickly. What is disinvestment needs to be understood very carefully. And if you see the evolution of this policy 25 years ago, when this department of the government was founded, it has been through four phases. The first phase was 99-2004, which was a learning phase, or you can say an experimental phase. The second phase, that is 4 to 14, was a phase of political constraints or coalition constraints. That is a better word. And of course, the strategic disinvestment took a backseat, but the department continued with minority stake sales. The department continued to engage with the capital markets. The third phase, which is 16 to 21, we would say was the revival phase, when strategic disinvestment was revived. And revived in the right earnest, because you see, and the fourth phase, which is 21 onwards, which is called the Atmanirbhar Bharat PSC policy, is a phase of integrated disinvestment policy. And what that means is that disinvestment and closure are two sides of the same coin. At a micro level, they may look very different, but at a macro level or in a general equilibrium framework, they both create greater space for the private sector. And if you see, as many as 50 public enterprises have been taken up either for disinvestment or closure in the last 50 years. And that has yielded dividends. You see such an exciting private sector manufacturing growth. But we must not forget that public sector also has a fair, bona fide role to play in our economy. There are certain strategic sectors, there are certain public goods, there are certain public services, there are issues of inclusion which are not for profit in nature. That is where, and of course, now in the present global framework, maintaining the security of our global supply chains, of our raw materials, of our minerals, is equally important. And therefore, when we talk about the disinvestment policy today, it means public sector does its job that is due to it, the private sector does what is due to it, and we share wealth and value that public assets create with the people of India, with the citizens of India, and with our small investors.
So let me just push back a little bit on that, because the banking sector, for instance, the expectation was that we would see privatization. That is not the case. In fact, we had the DFS secretary telling us that the government has no intention of bringing down holdings under 51% at this point in time. Telecom, another sector where the government has decided that from a strategic point of view, it does not intend to disinvest. So which are the sectors where strategic disinvestment is likely, where there is still an intent and an appetite to go forward with strategic disinvestment?
I would not like to comment beyond my pay grade.
So this is very much your pay grade. You're going to have to do this.
Okay, let me put it this way. I would not like to, say things which are beyond my immediate domain. But all I can assure you is that all major public sectors, including the financial sector, which is the banks and the financial institutions, are part of our disinvestment framework. You may see one or two big strategic disinvestments, but you may see many more, maybe half a dozen OFS or follow-on offers or different forms of minority stake sales.
So half a dozen minority stake sales by way of OFSs, etc., but one or two strategic disinvestments. Let me guess which one or two of those strategic disinvestments it could possibly be. IDBI Bank. So we're talking about reforms reloaded and accelerating reforms. It's been a disinvestment in the making for over a decade now. Are we going to close it this financial year?
Hopefully, yes. Honorable Finance Minister said it in an interview recently, and we are working hard day and night to make it happen.
By when will you invite the bids for IDBI Bank?
The only number timeline given out in the media is end of the financial year. A lot of things happen and are done outside the media glaze. So let the interested parties wrestle it out.
Speaking of interested parties wrestling it out, sir, would it be fair to assume that the foreign interest is higher than the domestic interest, specifically as far as IDBI Bank is concerned?
No comments.
I'm trying my luck to extract as much as possible from you. So IDBI Bank, of course, as you stated, is being targeted for this financial year. What could the second candidate be, sir, from a strategic disinvestment point of view?
Wait and watch. You will hear the announcement at the right time, and we'll make the announcement through you.
You'll make the announcement to us, so we will hold you to that, sir. But the other important aspect that you spoke of, and I think that's something that the market is also watching very closely, is the government's dividend policy. And perhaps you could shed some light on how you're looking at the dividend policy going forward as well.
Very good question. A fair dividend policy is part of our integrated disinvestment framework. And the reason is almost the same reason as the monetary policy. Essentially, it is the discretion versus rule, which is also called time consistency. And it's a very careful optimization between the investors and the traders. We don't give any targets to the private sector. We allow them to freely operate in the capital markets. For the public sector, we want them to be benchmarks. And so we create that nudge. And over the last 10 years, we have debated this internally. The policy framework has evolved and matured. And we now ensure that public enterprises who have moved bravely onto the capital markets and have won the trust of investors should pay 30% of their profit after tax or 4% of their net worth, whichever is higher, as fair dividends to small investors. And this has picked up. If you see in the last 5 years, the dividends payout by the public sector enterprises has doubled. And even though they occupy only 14% of the market cap in our capital markets, they pay 25% of dividends to the small investors.
So that will continue?
That will continue, and it will be, they achieved a record landmark last year. Almost 1,20,000 crores was distributed as total dividends, and we hope to exceed it this year.
You hope to exceed that number this year, 1,20,000 crores. IPOs, and I want to go back to that because the last big blockbuster from the government, of course, was the LIC IPO. What's the thinking? What would you like to prioritize in terms of the IPO pipeline? We talked about how strong the appetite has been as far as the primary markets are concerned. What would the government like to prioritize, given the global challenges as well as the appetite in the market from an IPO perspective?
Good. We are doing investor meetings and market research. You should expect that at least some public enterprises in the strategic sector or natural resources space, or maybe their subsidiaries, will be brought out and placed suitably.
So natural resources space. So you've given us a clear heads up there in terms of what the priority is likely to be, sectorally at least at this point in time. Okay. And how soon can we expect you to look at hitting the markets?
End of financial year. Anything before that?
This financial year. So that's the target. And how many are you working towards, sir?
No comments.
Okay, fair enough. Mr. Chawla, I want to take a little segue away from disinvestment to talk about something that I know you've very closely been involved with. I don't know how many people in this room know, but he's, of course, had stints at the IMF, and he's been very closely involved with economic diplomacy as well. As you look at what's playing out at this point in time with tariffs, especially with the ongoing negotiations between India and the US, what do you believe are likely to be the outcomes of these negotiations? How confident do you feel that we will, in fact, be closer to getting some sort of an agreement in the next few weeks?
Those who are not part of negotiations do not comment on it when particularly they leave those positions.
As an observer.
This engagement will continue. It's very difficult for anyone to predict which way it will go. But my own view is that we should not respond in a knee-jerk fashion, which is what we are doing. We should continue to work on our fundamentals, strengthen our economy, provide balanced support to growth, reorient our value chains, and at the end of it, it will pay us good dividends.
So, a calibrated approach is what you're essentially suggesting. But on the macros, as you look at what's happening, especially as far as the currency markets are concerned, and we've seen a fair degree of volatility there, how do you see the rupee and the move in the rupee also kind of offsetting some of the impact as far as exporters are concerned? But, what you believe the strategy should be there?
It's the domain of the central bank, so I would not give any comment on it. But being the market-facing department, whatever we see and whatever we research, broadly the rupee is aligned with the fundamentals, which is called the real effective rate.
Coming back to asset monetization, and we had that big plan as far as asset monetization was concerned. What can we expect now realistically as far as this financial year is concerned on that front specifically, sir?
As I said, I would reiterate that we are on course to meet our target. We've been planning it since the beginning of the year. We did a few things at the beginning, and when the headwinds come, we lie down, but we keep ourselves ready. And the moment the fresh breeze comes, we come out and I would say give fair returns, and if I may use my language, fair dividends to the investors.
Fair returns and fair dividends. Do you feel a fresh breeze, sir? Is it picking up momentum? Is it getting stronger?
Some major